All right. Welcome to another session going in deep dive for direct care owners. We're going to look specifically at the chart of accounts today, and this is going to help for those of you that are either doing your own bookkeeping, or even if you have a paid bookkeeper. It's helpful to understand the concepts of the chart of accounts so you can communicate with your bookkeeper in terms of what you need to see to be able to make decisions for your direct care practice and be able to understand what is actually impacting your business, especially when you start to get more and more disconnected from the financial side because you have hired somebody else to do this for you. So I'm going to share my screen. We'll go to a little slide deck that I have. So the big thing here is that the chart of accounts quietly decides whether or not your profit and loss statement makes sense. And so if you feel like your P&L feels confusing, it's not you. It's most likely your chart of accounts because this is the filing system that every number flows through. If you fix the filing system, then the whole statement can start to make sense. It might not always be good news, but it will start to make sense. And so, understanding this will help you understand the main financial statements. And so, the three things that I want everyone to walk away with by watching this webinar is understanding what the ideal chart of accounts would be for direct care owners, what to keep, what to kill. A lean structure built for membership medicine is way better than a very overbuilt chart of accounts that creates a lot of you're not able to quickly understand where the P&L is because it's 3 pages long or something like that. Miscategorization of expenses can really hurt your decision making. It can affect your tax bill as well for what's deductible and what's not. And it also affects when you're deciding, are you going to grow or not? And then the third is what your P&L should tell you. And so I just want to walk through the handful of numbers every month that you could put on a scoreboard. This isn't a tax chore. This is just like a monthly owner's checkup of how they could properly read their numbers. So let's talk about what a chart of accounts actually is. And there's one way to think about this is thinking about buckets. So when you create accounts, you'll create them within one of these buckets. We call these types or detail types if you're in an accounting system. But you have your income, and so that's all the money that comes in from selling and doing your services. You'll typically have cost of care, cost of goods sold, cost of supplies. Some people call this cost of sales. This is directly related to the cost of the care you provide. So it's your lab expenses, your um, medical supplies, your DME, all of that would go into your cost of care bucket. And so you might break out a couple accounts. Typically on the income side, we're going to have your membership income. That's where we want the recurring membership revenue to go. That's the fee that they pay every month. We'll have a lab fee income account if you charge for your labs. We'll have a medical supplies fee if you charge for medical supplies. And then we'll have the prescription fees as well if you charge for any sort of prescriptions or supplements at your practice. Then you'd have a directly related expense account to that. So you'd have the lab fee expense, prescription expense, and medical supplies expense. So you could see if you're breaking even or making money on your cost of care. The next thing you're going to have is going to be operating expenses. And that's where all of your rent, your insurance, your payroll, all of that's going to end up in your operating expense bucket. And we'll have those accounts underneath. We wouldn't just say operating expenses. We would want to have accounts like payroll taxes. If you pay state taxes at the entity level, those are going to end up in your operating expenses. And then you're also going to have this owners and team pay bucket. So that is the chart of accounts for your profit and loss statement. There's additional accounts for your balance sheet, which is like your loans and your checking account and your money that you've invested into the company. But in terms of the P&L, these are the accounts that we would put, and these are the buckets that we would want to see on a chart of accounts. And I think one way, and a big distinction here, when you're thinking about bringing on a bookkeeper or if you're thinking about hiring a CPA, if you have a lot of different clients in an accounting firm that run a lot of different types of businesses. It's hard to streamline the chart of accounts to give you the information that you need. And so, because you don't run like a retail shop, you don't have inventory of clothes, you don't have all the sales tax issues, you don't have, multiple revenue mixes with the different types of products you're trying to track. You usually have membership income. You might have some ancillary services, and so that chart of accounts needs to show you that, opposed to just a generic chart of accounts you might find online. We have chart of accounts available for people here for what we see as would be a standard DPC ones. That's in our resources section of our community. If you need it, you can always just shoot a message to me. I'm happy to help provide that. So the things that you would want to have to be able to see is recurring membership revenue. We want to see your monthly recurring revenue. We call that MRR. That behaves nothing like a fee for service business, right? You're not People aren't just coming to see you one off and you're charging them. You should have a client or a patient that is paying you a monthly fee to receive value month over month, just by having you available. Cash pay, you're not insurance, so we don't have all the accounts receivable claims. There's no aging schedules that we're tracking. Um, the only time I do see people having an AR system for their direct care practice is when they charge for those labs and prescriptions with an invoice and they don't collect at the visit. We discourage against that. I would just collect the payment for what you're going to have to owe to that for those lab fees. But we do have some people that do charge by invoice and they don't get paid. So it's important to track it, but it's not near the volume of every single visit going to the insurance company. And then you'll have supplements, labs, and ancillary services. These are real products that do have a margin. Like I said, those are their own line. And then we need to understand owner operator economics. Um, you, as the owner, depending on your type of entity, if you have just started and you have your LLC set up, you are not going to be setting yourself up on a W 2 payroll inside of your company. You're an owner, you still are operating the business, you probably don't have any employees yet. So, you and the business, in the eyes of the IRS and in the eyes of your state tax agency, are relatively one and the same. And so you can take a distribution for yourself out of the company to pay yourself, but you're not gonna, get Gusto or QuickBooks Payroll or one of those softwares to run payroll for yourself yet, because it's just you and the LLC. When you decide that it's time to elect to become an S corporation, typically, or that's when you will set up a payroll software, and you will then be a employee of your business, and you will take a W-2 salary uh, on a regular basis, and you can also take distributions as a shareholder. You just want to make sure that you have calculated correctly what you pay yourself, because the IRS wants you to have a fair wage when you're an S corporation, so you're not trying to avoid self-employment taxes. And I definitely think the last next part is talking about the five buckets inside of the DPC chart of accounts. So we talked through those buckets: the income, cost of care. But when we think about it, really, when you want to look at your P&L, like, you want these five buckets. If you've got just tons more in here, you're packing in a lot of detail. I've seen people that have everything broken down by vendor on their P&L. So it's like Spectrum, and then instead of it being utilities and internet or rent, we have the lines of like all your software expense. Instead of it being software expense, we have, you know, Hint expense, your Atlas expense or Spruce expense, and like line by line. And it's so much detail, it's hard to tell, um, where there might be something going awry, because there's just so much to look at. So under each of these buckets, I've given a couple examples here. So cost of care, that's your cost of goods sold. It's meds, lab supplies. Operating expenses, think about it as rent, software, marketing, admin. And then owners and team pay. You do want to keep the owner pay separate from your staff. So what you could add that back to your bottom line, basically showing, what is my contribution that I'm getting from this company. and then the other expenses, so your interest, your taxes, and your one-off expenses. I've had like an account for hardware expenses where I'm buying, fixed things that are lower than $2,500. So I'm not putting them on my balance sheet as an asset. Like I'm buying doorknobs or a table or something like that. I want to separate it because I know it's not going to be every single month. It's not going to be my office supplies, but it's also not an asset that's big enough for me to worry about depreciating. So a big thing here, let's talk through bucket one. We want to separate your revenue streams enough, but not so much that you can make decisions. One of the core numbers that we want everyone to measure is membership revenue. So you have recurring monthly or annual dues that your patients are paying to you. That is your core MRR. It's one of the most important metrics that you measure as a business owner because that is the lifeblood. Another big one is separating out your enrollment and one-time fees. We want to know what's recurring and what's not recurring. So by pulling out your sign up or onboarding fees, setup fees, we want to see, okay, because we just opened and we're bringing on 10 or 15 patients a month, I'm going to have a big jump in my enrollment fees that I'm not expecting to have the next year. And then we have ancillary services. Most direct care owners that I talk with have something that they provide that people in the community will come and receive benefit from just to get exposure to the clinic. So, ancillary services, you have your labs, you might provide imaging if you bought an imaging machine, you might have procedures that you'll do. Some people do aesthetics services, some people do weight loss management services, mental health services. We've seen a lot of different things that people specialize in. And then some people do an in house visit for people as well in their membership revenue, but they'll charge separate if they need to do a house visit. Then we have products and supplement sales. So we do have a lot of people that will partner with various supplement groups. There's like Thorn and yeah, there are a couple other groups that you can partner with to give discounted supplements to your patients. And so you'll sell those or get some sort of benefit from that, either a kickback or you might just try to do it at cost. We want to track that separately to know what we're spending and what we're making off of that, off products and supplements. And then another one that's a little bit different is understanding the difference between your retail patients, your people who are just families paying a membership revenue, and your direct contracts. Especially if you run a really heavy employer direct and DPC business, it's helpful to see how many retail patients do I have versus what's the revenue I'm bringing in from these different direct contracts. That split helps you understand where your concentration is. So then the next is the cost tied directly to care. We pull these out of operating expenses. By doing so, we can really understand, what are the variable costs that we have for each patient. So we have dispensed medications, wholesale drugs that you cost and you pass through to them. It's just like at cost. You might have lab and imaging fees, medical and clinical supplies, merchant and processing fees. You can put this up in the cost of goods sold because it's just directly related to those card fees that they're paying you. That gives us a gross profit if we take the revenue and subtract out these expenses to know, okay, what is our gross profit margin? Like what percentage or what amount of cents do I keep for every dollar that I can then apply to my operating expenses? So then we want to keep our overhead clean. Uh, Rent and facilities is a standard bucket, EMR and software, marketing, admin and payroll, insurance, dues and subscriptions, and professional fees. If you wouldn't make a decision from it, then don't give it its own account. 10 well-named categories can beat 60 sub-accounts that nobody reads. So we like to say kill the vanity detail. Some people get really a lot of pride over their detail in their profit and loss, but they can't make very quick decisions as an owner, which is important when you're trying to make decisions as you're running your business. And these categories really can consume most of everything that goes on within the business. You might add office supplies in here, or some other expenses depending on what you're doing. But this captures a lot of what happens on a regular recurring basis. And we can very quickly say, okay, here's our overhead. This is our monthly fixed expenses that we pay every month. What do I need? How many members do I need to break even and pay for these expenses? Another helpful thing is your pay is not the same as profit when you are on payroll. So owners' compensation is kept separate from staff payroll. So you can see it clearly. Distributions for salary. This split is driving some of your tax bill, specifically what you pay in FICA taxes. And then reasonable compensation is needs to be documented to know why you're paying yourself what you're paying. It's not some number that you plug or make up. Miscategorizing owner's pay can distort both your profit and your tax position because most of the time we want to take profit plus owner's comp to know what your profit is. Some people will pay themselves a lot W 2 and they're spending that personally, and then they'll have a loss on the business and they'll start freaking out. And we're like, hey, it's okay. Let's look at what you paid yourself. So there is profit. It's just getting absorbed in your owner's comp. And so having that kept separate really helps you to be able to make more educated decisions. So, what to keep, what to kill, 5 income streams, get a real cost of care section, have your owner's comp in its own home, 20 to 30 total focused accounts on your profit and loss statement, and then names that you actually understand. So if you don't understand what something means and you keep having to go back and figure out what it is, um, rename it to something that makes more sense. That you can also ask your accountant to say, does this make sense? Some things to kill. We have a lot of people that have an Ask My Accountant account that just gets loaded instead of just trying to keep things on a regular basis. So people have 60 sub accounts. No one reads that. Personal spending mixed in. Always keep it separate. Get a business credit card and a business bank account. Don't dump everything into supplies. Give those some clarification. Is it medical supplies or is it office supplies, right? Does this relate to the cost of care or does this just relate to running and having the office open? And then any duplicate or near identical accounts. Whenever we go through and do a chart of accounts cleanup, we kill so many duplicates that there's just a lot of confusion in what the total spend is. So, what happens if we have a bunch of buckets, but they're the wrong buckets, right? So, some things we've seen supplements get booked as office supplies, so we don't really know the margin on our uh, supplement income if we're actually making anything on it, or even breaking even. We're maybe losing money, and that's why we're at a profit or a loss. Owners' health premiums get buried in insurance. We don't have something separate for benefits for employees. We can then miss a deduction for if you're set up as an S-Corp. Equipment gets expensed in full. It's not capitalized. So this can distort a month if it's not broken out to either the balance sheet or if it's a low cost equipment. It's not in a place where we know that it's a one-time thing. They're the same dollars, right? At the end of the day, the bank statement doesn't lie, but the buckets and the decision making gets distorted, and it can make for a very different tax bill. So the wrong buckets can really cost you. So now that we've talked about the chart of accounts, what would your P&L tell you if we had a really solid chart of accounts that was easy to read? Every month, you could run this month over month statement and get your membership revenue trend. So, is my monthly recurring revenue climbing or is it flat? Gross margin per member. So, if I have a $100 membership out of the gate, I'm gonna have a cost associated with that. A lot of the software costs are per member, but also like if we know every member gets a lab, it's included. Every member gets a certain amount of supplements. What's left, right? We might only have a $70 membership after that because we spend $30 per member that's just built into their cost. And then owners pay versus profits. You know what you're making and what the profit is. You know your operating expense ratio. So, how much overhead do I have, and what percentage of my overhead is revenue? So, do I spend 50% of my revenue on my overhead? And then cash on hand. We get months of runway at a glance. We know how much cash we have on hand and how long we have until we run out of it. So this is a lot of thought, right? And thinking about how we could actually do this, but I want to make this more practical. So I want to walk you through just the sample QuickBooks and show you where a chart of accounts is, what miscategorized expenses can looks like, how we can fix it, and then we can run the P&L before and after to show you also then if you want to import a specific um, chart of accounts into your QuickBooks or your accounting platform. So let me pull this up real quick. And I'm just going to pull up a sample uh, QuickBooks Online account here, and this will help us see. So then, so you might have a different accounting software, but in most situations, if you're in control, if it's Zero or Wave or Zoho Books or one of those, almost all of them, they'll have a accounting section and they will have the chart of accounts, or they'll have a navigation menu, and you could just type chart of accounts, and it should jump you to that chart of accounts. So this is the sample chart of accounts that is in every QuickBooks test drive account. So they give you a lot of options, um, and this one specifically is the same company every time. It's like a landscaping company, but the principles here are the same. And so if we just look at this section, right, this is a lot of detail, but it's going to be organized by type. So we're going to have a balance sheet account and the types of balance sheet accounts, and then we're going to have those profit and loss accounts. So we have income accounts, the different types of income that this person is measuring, and then if I just came in here, I can edit and rename some of these. So if we just said, member revenue. So this is our recurring revenue every time, and I'll make this our services and fees. And then we want to have some lab fee income. I like to put income in our lab fees so we're not going out and having a confusion on if this is an expense or not, because this account type doesn't necessarily pop up when you're categorizing things. And so I like to put if it's an income account or if it's an expense account, specifically for the ones that we have very similar names for. And then if I came down, I could go to my expenses, but we have here cost of goods sold. This person doesn't have any cost of goods sold except for this one. I'll just rename this one for now. And we'll call this lab fee expense. So I'm not going to go through the whole chart of accounts and just rename everything, but if you get here, one of the things I do, I scroll through all of the accounts when I look at someone's QuickBooks accounts and say, we got a lot of stuff in here. Is stationery and printing? Are you doing a lot of stationery and printing, or is this just like, should this be office supplies? And in most situations, you can actually rename something and merge them. At least in QuickBooks, you can. And this is kind of the hack opposed to having to go through and like reclassify all your transactions. If I wanted stationery and printing just to end up in my office expenses, I could name this the same account, make sure that my account type and detail type are the same. I could then click save, and then it's going to say, do you want to merge these accounts together? Yes. And all the expenses that were in that account are now getting combined with my other one. So now if we go in here, we can run the P&L, and I then can see how well these things are classified. So if I came down in here, we have our uh, membership revenue. We can assume this, right? So we have, $6,500 from January through July in membership revenue. My total income for that period is $10,000, and I spent $400 on my lab fees. And then if down here, I think we had lab fee income. Looks like these months we didn't have any lab fee income, but we had lab fee expense. That'd be a flag for me because I would say, hey, we paid for these, but did we never charge a client for any of these labs? We're losing some money here, unless it's just maybe you include it and you know that you include it, so that would be okay. So we have a gross profit of $9,700, and then we would scroll through here and say, okay, all these expenses, like there might be a ton of detail. Is this too much detail, right? Can we make decisions off of this, or can we make decisions off of if we kind of shrink this down? Can we make some decisions based off of a smaller P&L much more efficiently? And then the next kind of piece to this is understanding miscategorizations. And so one thing you could do is run things month over month, opposed to every single, like a big bulk period like that. And what I could do is see, do we have just consistency across all of our accounts? And we paid our lawyer, and we could see, is this actually that person? Or sometimes what happens is a lot of people will have these accounts, and what I do when I want to like make sure things are classified, I just go through each line and I click in to get the detail, make sure we're actually spending it on what it was supposed to be, and if not, I can just open this transaction and reclassify it to the correct account. This process takes some time to move around, miscategorize expenses, but it really pays dividends when you get to the next year and you're trying to compare, hey, how did I do this year versus last year, and what's next for our business? And then if you're at a place that you're just getting started, or you really want to overhaul your chart of accounts, to do this, if you're overhauling, I would come to this chart of accounts page in QuickBooks. If you're using a different software, I'd go to that chart of accounts page, and I would do the process of merging accounts that are duplicative, and I would rename accounts to actually the things that you could understand. If you're new, if you come and open a QuickBooks account, there's most likely like 5 to 10 accounts in here that are default, and the rest is empty. And you can do an import of a chart of accounts, and they have a template that you can use, but we have created a template that we provide to folks to be able to do this. And you can find that inside of the resources section, where you could take that and immediately upload it to QuickBooks, and you immediately have the accounts that we recommend. All right, let me flip back over here to the slide deck. So we would love for you to steal our chart of accounts. Whether you use it as a reference, so you know what you want to put in there, or you want to actually go through and do the import process. And then you can review it with us. You can bring it to the monthly office hours that we have, and we can look through your chart of accounts together. And if you're having issues with trying to merge things or run into problems there, we can do that together. So feel free to send us a message if you're interested in stealing our chart of accounts. All right, last three things. Three things to remember here. Your P&L is only as good as your buckets. Fix the chart of accounts, and the report will tell you the truth. Separate your income and pull out your cost of care, so you can know where you have margin and what your cost for each patient is. And then read those 4 to 5 numbers every month and treat this statement as a scoreboard that you can actually make decisions on. If you have questions, bring your P&L to the next weekly or monthly Ask Nate, and I would be happy to answer your questions, and we can look at it, live together, so you can have a really good understanding of your P&L with some action items that you can do every single month. Thank you guys so much for joining. If you have any other questions, feel free to reach out to us. You can go visit us also at goodmancpa.com. Thanks.